is the second of two that we've done to healthcare professionals over the last week or so. Just to say, I'm going to get started in the next kind of 30 seconds or so, but just before we do that, I'm just conscious of people logging in. We have put up a poll today. We're just kind of trying to gauge interest on areas that you might be interested in hearing about for any future webinars. So please feel free to complete the poll, which you should hopefully be able to see up on the screen. So just to introduce myself, for those of you that are not familiar with myself and Alpha Wealth, my name is Nick Shaw-Lambus. I am the Managing Director of Alpha Wealth. I'm joined by two of my colleagues today, Keenan Cunningham and Cliona O'Donoghue. I'm going to spend the next 20 minutes or so just going through a few areas as to how you can reduce your tax significantly over the next few weeks. I do think there's definitely an opportunity, particularly as we come towards the tax year end, which is the 16th of November, particularly for PAYE and self-employed people. So I'm just going to get started, and I can see some of you are completing the poll. If anyone does have any questions, and I really would encourage you to ask questions, any questions at all, you can do it anonymously if you prefer into the chat section. We have been sort of accumulating questions over the course of the last few weeks, but we want to make it as kind of interactive as possible. So please do put in any questions at all that you'd like to ask. And if I don't answer them immediately, we will get back to you. We're more than happy to provide any guidance to you. So just to start with, we're a Cork-centric company. We have an office in Little Island, but we basically have an all-island presence. We do provide Zooms, team meetings, and personal reviews all over the country. There's currently 8 of us that are QFA qualified, giving independent financial advice to individuals like yourselves. With regards to today, I just wanted to go through 4, I suppose, takeaways really. The first of which is giving you, I suppose, and helping you set up your financial goals. The second, which is the crux of today's session, which is helping you to reduce the tax. And there's really 2 things that I think you can do. One of them is to look at your pension provision, and the second is a 5-year tax-back scheme. I want to help you, I suppose, finance these, because both of those plans come at a cost, and I just want to get you to understand about how we operate as an independent broker. And then finally, we are offering an opportunity for anyone who is interested to book a discounted financial review with us. And as I said, there will be a section at the end for questions. So in terms of financial goals, the starting point really, as we engage with people, is to ask them about what is important to them. What are they looking to try and achieve at this stage of their financial life cycle? I'm 48 years of age myself. I have 4 children. I'm looking at, trying to, I suppose, get to a point of financial independence over the next 13 to 15 years and help my children through 3rd level education. They're my main important goals. But obviously, depending on what stage you're at, you may have very different ones. It might be a case of trying to get your first house or looking to try and get out of debt. So we help people navigate this, understand where they are, and really, and most importantly, and hopefully you can see this on the screen, is to set out a roadmap. Most of what we do with financial planning is about providing balance. I had a review earlier today with clients who had too much money actually in the bank, which may sound like a strange thing, but the money wasn't really working for them, and they had underutilized their pension opportunity. And also, they didn't have any provisions in relation to medium-term savings, particularly for their children. And all I did was just help them understand and see that there are different, I suppose, vehicles available to them that they could use to a better effect. Now, I'm just going to talk briefly about the 2 ways to reduce your tax. And I really think for everyone that's listening, if you're employed or self-employed, and you're earning money, and it may relate to your partner as well, of course, that there are really generous limits to making contributions into your current pension scheme before the 16th of November. And the way I'm going to describe that to you is to say, for example, you're earning 50,000 a year. You have the ability, if you're in your 30s, to put 20% of your income into a pension scheme. And that applies not only for this year, but revenue will also allow you to go back for 1 year. So obviously 20% of 50,000 is a gross figure of 10,000. And if you double that up, allowing for last year, the total contributions you can make into a pension scheme would amount to 20,000. Now, let's say you had only allowed for 5,000 euros of contributions up to now for the last 2 years. There's a gap there of 15,000 euros, which if you were to pay that figure into your pension now, revenue will give you a deduction of 6,000 euros. The example on the screen there is for a total of 20, you get back 8, which is really significant. You know, I say this all the time, pensions are vastly underutilized. I really would encourage you to think about your opportunity for the next 8 weeks or so, that you can make a contribution and get immediate relief of 40%, which if you think about it, if you have something that you invest 6,000 into and it immediately turns into 10,000 because of the tax break, it's a return of investment of 66%, okay? And that's really the powerful tool. The second thing I'd like to talk to you about today is investing in a 5-year scheme, which is a government-backed scheme called the Employment Investment Incentive Scheme. I'm going to talk to you briefly about that as well. A lot of what I say to my clients, they sort of understand. The problem is for a lot of them, they suffer from the fact that they just don't have the time to address these things, and they don't really kind of, I suppose, know about how to navigate the industry insofar as like pensions. For example, the key questions we ask are, do you know what the current value of your pension is? Do you know what level of contributions are going in? And do you know where your funds are invested? And some people have, I suppose, some notion of some of the answers to those questions. But the key one that most people don't realize is, do they know what their pension is likely to be worth when they're looking to draw it down? And this is the piece that we help people with. So for the purposes of today, we would encourage you to reach out to us. We, as I said, are offering discounted financial reviews for anyone who is on this call or listening on playback, whereby we will get the information on your behalf. We don't expect you to do anything, and therefore help you find out that if your pension scheme is being managed appropriately, is in the correct funds for you, and most importantly is, do you have this roadmap that I spoke about? I've just put up on the screen the type of pension administration that we do, and this is based on my own circumstances. So, for example, based on a current fund in my pension scheme of 200,000, looking to draw this scheme down at 65, which can vary, and a lot of what we do is to make it specific to the individual. Some people want to try and become financially independent at 60. It doesn't mean that they'll stop working. It just means that they'll be in a position where they don't necessarily have to do the same job, or certainly not to the same degree. But the key thing is that based on my current trajectory of a contribution of 1,000 euros a month, of which I'm funding 500, costing me 300 because I'm getting that 40% tax relief, and the company is paying 500 a month for me, that's 1,000 euros a month going into the scheme, based on assumptions of growth, which are quite conservative, and the fact that I'm going to try and keep them in pace with inflation. My pension fund is going to accumulate approximately 881,000 euros. The thing to understand is that inflation will pare that figure back down to circa 630,000. You might be wondering whether this is a really good or bad pension scheme, and I'm not showing you these figures to gloat. I'm showing you these figures to get you to understand about where you are and really where you're likely to get to. And lots of things can change, of course. I've changed countries, I've changed jobs, I've become a business owner. But the point being is that I've always tried to keep a roadmap in terms of where I'm looking to try and get to. And of course, you know, we adjust it. And the most important thing is that we review this once a year. In terms of the limits, they are extremely generous. So for anyone who is working, you can pay up to a maximum of 40% of your salary, depending on your age, into a pension scheme and get that tax relief. And as we found out in the budget earlier this week, you can basically earn up to 40,000 a year at the lower rate. Pensions really become attractive for anyone who's earning over 40,000 a year. So for anyone of you that are, I really think this is a huge opportunity for you. Even if you're only earning 40,100 euros a year, you still get the full 40% rebate on your contribution. And that's typically at source. So it's not that you have to go looking for the tax claim, it's done for you immediately, and we can get you to understand that. And we have no bias, obviously, for anyone who is part of a pension scheme currently. We're more than happy to provide you the guidance. We're not looking to try and sell you a pension. For those of you that have previous pensions with previous employments, we would generally suggest that it was really worthwhile reviewing those. And obviously, if you have a pension scheme and you're not sure whether it's in the right fund or whether it's expensive in terms of fees, I would suggest that a review would well be worth your while. You could save yourself thousands of euros over the course of the retirement term. The next thing I just want to show you briefly is how much you should be aiming for. So obviously, I showed you my own trajectory earlier, and there's three numbers that I always talk to clients about that I think are realistic. So for any of you that I suppose are looking to, in the early stages of your career, particularly when you're in sort of your 30s, early 40s, I say to them that it's really a case of trying to aim to get up to a figure of about 400,000. Now, some of you may be more progressed than that, or indeed, if you're older and maybe had funded, quite heavily up to now, the next, I suppose, sweet spot would be 800,000. And then the absolute maximum that you should be looking to get to is 2.15 million, which may sound very large to some of you, but I assure you that there are some people in Ireland that do achieve that figure. And again, it's about where you are and about what you're trying to achieve. But there may be people that retire on a much lower figure than that, and that's not really the mainstay of this. The reasons for those figures are that, as it shows you here on the screen, if you achieve 400,000 at, say, 60 or 65 years of age, I believe that should be sufficient to help you get through the remainder of those years. The way that would work is that you typically get a quarter of the fund tax-free, which in this case would be obviously 100,000, and that you generate a return from the remainder, which would give you roughly about 24,000 per year. And obviously the state benefit typically that we pay to most of us, which currently kicks in at 66, will give you a further 12,000. The next threshold of 800,000, the reason why I've used that figure is that that's the maximum amount that you can draw tax-free the quarter without paying any additional tax on. It doesn't mean that that is the only number that you should aim for, and for anyone that can get a higher figure than that, they should. But it is a number that makes a lot of sense, because that gives you that 200,000, as I said, which currently is the maximum amount of tax-free cash you can take from your pension fund, and then the remainder typically would generate a return very conservatively about 36,000 a year. I have some clients who, are, I suppose, in a situation where their partner isn't earning as much or may not have a pension scheme, or vice versa. And what I try to do is say to them that you should try and, wherever possible, look at your situations in combination with each other. There's no point one person having a really good pension scheme and the other person not really understanding about the opportunity or benefit. The main thing, though, to understand is that it is only really applicable for the person earning over 40,000 a year to fund their scheme more heavily. As I said earlier, if anyone does have any questions, please do put them in the chat. We will be answering any questions towards the end, so I would encourage you to do so. I'm not going to spend too long on this, but just this is a very quick worked example of someone who's in their 30s, earning the 50,000 a year. And just to show you how powerful pensions can be over a long period. If they don't pay into a pension, they would typically take home about 37,000 a year. If they made a contribution to their pension of approximately about 7,500 a year, they would get 40% tax relief on that. So it costs them only 4,500. So their gross payment of 625 per month would basically net out in total to 375. And that alone would achieve a pension fund of approximately 930,000 euros, which is really significant for basically a cost of 375 euros. The key thing in this example is to give yourself as much time as you possibly can. You will see a lot of information from the financial services industry over the next number of weeks, particularly on the radio and in the newspapers, about reducing your tax. The reason is that this is the step back a year, as I mentioned. So you can make a contribution now and claim tax that you paid last year, in addition to making contributions for this year as well. If any of you have set up a business, again, there's a really good opportunity for you, like myself, where you can get your company to pay into a pension scheme. And the benefit of that is that the company wins because it doesn't pay the 11% employer's PRSI. So it saves on a contribution of, say, 10,000, about 1,100 euros. But also you don't have to pay the whack of tax, which is roughly about 52%. It all goes into the pension scheme. One of the things that some people don't necessarily know is that you can, in some cases, use your pension scheme to buy a property. So for anyone who has built up a pension scheme and maybe left employment previously, and they have, say, 200,000-300,000 built up in their pension, it is possible for them to use that. If you're working for, say, the HSC, it wouldn't be possible to use that scheme. But for anyone who has a private pension, there is an opportunity for them to do so. Now, again, there's pros and cons of doing so, but I can explain to you the benefits and certainly give you some information on that for anyone who's interested. Please do feel free to ask any question, or indeed you can message me separately at any stage. Okay, I just want to talk briefly about the second way to reduce your tax. And this is a scheme known as the Employment Investment Incentive Scheme. It's basically a 4 to 5 year scheme. I'm going to say 5 years to err on the longest period typically that the scheme would run for, where you make a one-off contribution. It's a personal investment. So the example here is, say, 5,000 euros is a minimum amount, where if you have that money in the bank and if you are paying tax at the high rates, so i.e. earning over 40,000 a year, you can invest that for 5 years and get 40% back from the government, which is obviously 2,000 on the 5,000 euro payment, with a view to get your money back after 5 years and also interest. You'll notice there's the Blacks of Kinsale, which is a court-based company, and also a couple of other examples of another whiskey company in Cork. I'm not obsessed about whiskey. They tend to be two very, very good companies in this space. And there's an IT company called MX that we would basically narrow down the 60 or so companies each year to what we consider to be the best 2 or 3. This worked example really just illustrates the point that if you have money in the bank that's not working for you, and if you have that 5-year threshold that you can invest for, I really think this makes a lot of sense to explore this and consider whether it's worthwhile or not for you. We have no bias in the company that you choose. We just want to make sure that we, as an independent broker, give you the best choices available and offer them to you at the lowest fees. Typically, the fees on these schemes are very low, around 2%. So for a 10,000 contribution, you pay 200 euros as an all-in fee. With respect to the two companies, I'm just going to talk very briefly about them. So Blacks of Kinsale is one of them. I met with the business owners last Friday. I was up in Kinsale. I had to look at the site that they're developing, and they're a really, really impressive couple. They have 8 employees. They've won various awards, extremely knowledgeable, very, very affable in terms of their way that they've dealt with, I suppose, their business and grown it since 2013 to a valuation of 15 million today, turnover this year of 3 million, profit last year of 675,000, and they're raising 5.4 million to basically build out this distillery in Kinsale, which would be like a mini Jameson's, with a kind of, I suppose, kind of a tourist area as well, and a bar. It's a really, really good proposition. And anyone who would like some more information, again, we're more than happy to share that with you and provide you more up-to-date information, including financials on the company. The second company that I want to mention is called BVP. It's a renewable energy company that provides a fund. So they invest typically from 3 to 9 companies every year. They've been doing so since 2007. Where the same, I suppose, structure applies. You get your 40% relief. They update you in relation to how these companies are doing, the selection process, which is really impressive. They target about 15% per annum over that period, which is obviously very attractive, bearing in mind that approximately 8% of that is the government's tax relief to you. So even if you were just to achieve your return back in 4 to 5 years' time, you would have made 40% in your investment by just virtue of the tax relief alone. As I said, we're more than happy to provide details of both these companies and indeed 1 or 2 others for anyone who would like some information. Just want to mention very quickly before we get into the questions, and again, please do feel free to ask any questions if you'd like, how to finance these schemes. As independent brokers, we help clients save money. There is huge opportunities, in my opinion, particularly at the moment, for people to renegotiate the rate of their mortgage. That's not with changing the bank. It's just by dealing with their current mortgage provider and making sure that you are on a very good interest rate for the next 4 or 5 years. And I can help you understand that, but typically it's a really simple thing to save you thousands of euros over the next number of years. Plans like mortgage protection, insurance, house insurance, car insurance, we're seeing people pay excessive amounts of money for these plans. I would say to you genuinely, for anyone who is paying more than 25 euros a month for mortgage protection, I do believe that you should review it. Unless you're both smoking, or indeed you're smoking as an individual applicant, I certainly don't believe you should be paying anywhere near that sort of premium or above. Same for house insurance, car insurance, and so on. And again, it's about helping people understand how to manage their money. We provide you a very simple financial budgeter and help you make sure that you are doing the best with the money that you have. And there is a free budgeter on our website if anyone would like to just download it and populate it. It would be very, very helpful. And I do encourage everyone to do it at least once a year. The final thing I just want to say is we are offering this discounted financial review. It normally costs 199 euros plus VAT. We're offering it to anyone who is on this call. Please do mention that you have been on the HCP call today, or indeed if you're listening to it on video, because our fee will go up from the 1st of October to 199 euros. Many financial advisors charge between 500 and 1,000 euros for the type of service that we provide, which is basically providing you with a very simple financial plan, helping you save money and getting you to meet your objectives, and more importantly, reviewing them with you once a year in relation to your plans. So just want to finish by saying I am doing one further webinar on tax on Thursday, the 13th of October at 8 p.m. Again, it's really just to get into a little bit more detail on a couple of the concepts that I spoke to you about today. For anyone who would like to register, obviously, please keep an eye out on our Instagram page, or again, email us and we can book you in for that. So I just want to pass you on to my colleague, Tina, who will just go through a couple of the questions.
Okay, thanks, Nick. Just some of the questions that have come in, and again, encourage people just to pop in any questions that you like in the chat box. But can you give an indication of what effect, if any, the budget this week had on pensions?
There was very little impact on pensions in the budget. The only small thing really to take countenance of is that because they increased the band of which you pay the higher rate of tax, for anyone who happens to be in that sort of category of 37 to 40,000 from the 1st of January, they won't be getting the relief at the higher rate. It's a very small thing, but just to bear that in mind. But other than that, there was no changes to pensions in any shape or form, which is actually a good thing, because there was talk about some adjustments, but thankfully that hasn't happened.
Is there a maximum that I can top up my pension by in a year?
The maximum is based on those earnings related limits that I spoke about earlier, which are very generous. As I said, for anyone who's even in their 30s and in 50,000 a year, that's 10,000 a year of contributions. And this does not include your company contributions. So some people get confused and think that if your company is paying 5% of your salary into a pension, if you're in your 30s, that means that that 20% goes down to 15. It doesn't at all. So it's always based on your salary in your limits, and whatever your company pays in is completely separate.
I have inherited money. Would it be best to pay off my mortgage or invest in my pension? Or do you have any other advice that you can provide this person?
There's no hard and fast answer to this. It really depends on your personal circumstances, and sometimes it is about balance. Again, I had clients earlier who had money in the bank and had a tracker mortgage, and because they felt and they've read previously that tracker mortgages are really attractive and you hold on to them with dear arms, that they weren't going to pay off any of their tracker. But the thing they were missing is that they were earning zero in the bank, and yet their tracker, even though it was quite an attractive tracker, and there's some bad trackers and some good trackers, and again, I can help you understand which it is that you might be on, but because of the recent rate rises we've seen, which total 1.25% in the last 3 months, even a good tracker is costing over 2% a year. Now, that still makes sense for them. I said to them that, if you allow for the tax that you're going to pay on a savings account, it would be the equivalent of about 3.25%. And I said, well, if I could guarantee you 3.25% of no risk into a savings plan, would you do it? And they said, yes. And I said, well, that's the tracker mortgage that you have. So the short answer is really, it's about your financial goals and objectives, as I said at the start, and maybe just trying to allocate different parts to make sure that you're not under or overfunding any.
As a GP, we are told we can only pay into ABCs alongside our GMS pensions and not allowed to pay into a private source. Is this correct?
It's not, and it's a bit of a misnomer amongst GPs that they believe that they have to fund the I suppose public service pay before they can pay into a pension scheme privately. And again, depending on the amount of income that you're on, it would vary in relation to the ratios. But the point is that those ABCs that are applicable to your public service pay can be done separate to the GMS scheme. The GMS scheme is only okay, in my opinion. And again, I can qualify that for anyone who is on the GMS scheme. But certainly the returns that it has achieved and is likely to achieve in the coming years is not likely to be very good. It's a relatively conservative scheme, and hence why it would make sense to review your arrangements.
Given the current climate at the moment, should I be investing my pension in a high or a low risk fund?
I don't think we should take too much countenance of what's going on at the moment. There has been obviously quite challenging times, as we've seen, and we're hearing it obviously over in the UK at the moment, but pensions are long-term vehicles, and we must remember that the longer you invest for, the more risk you should accept. So really what I would say to you is make sure that you've at least reviewed your existing arrangements, and particularly if you're funding your pension going forward, that you're not taking too little risk, but that you're not taking too much risk either. But as I said, really the short answer to the question is, the longer you have, so say if you're in sort of your 30s, you should be taking more risk than when you're in your 40s and so
on. I want to retire at 55. Can you give me the best options and what to do to achieve this?
My best advice really is to financially budget so that you know exactly how you're using your money. Obviously that deals with the problem of overspending in certain areas. And secondly, that I think pensions, as I've said earlier, is a really, really powerful vehicle. I find it really hard to believe that anyone can successfully become financially independent at 55 without significantly building up the tax-free mechanism that applies. Now, obviously, you can interject the likes of the EWS scheme that I mentioned, and indeed, there may be other assets like investment properties and so on, which respectfully are not as tax effective. But again, it's all about finding the right amount in portfolios, but definitely max fund your pension out.
Great. And this is the last question then, is I have a pension from a previous employment. What should I do with my old pension?
The main thing is to get it reviewed and make sure that you understand what your options are. A lot of people move their old company pension schemes for several reasons. One is to have more control and transparency of the scheme. The second is that they can get access to the scheme from the age of 50 if they move it into a standalone pension vehicle. And thirdly, that you can sometimes save quite a lot of money in fees. So for those three reasons, it's definitely worth exploring the options, making sure that you deal with someone independent, and obviously understanding where that pension fits into your overall financial planning cycle.
Okay, great. I think that's it in with the questions. So
great, thank you.
Thank you.
Well, listen, I just want to thank you for your time. And as I say, if anyone is listening to this on playback, obviously we're more than happy to take any questions at any stage. Please do feel free to email in. You can email me directly, nick@alphawealth.ie, or certainly you can contact us via our Instagram page or our website. The results of the poll, I suppose, just say reducing tax seems to be the big winner, 78%, and then followed by planning for your retirement. I hope that you found this webinar useful. As I said, I will be doing a follow-up one on the 13th of October. And most importantly is, if you feel there is any area of advice that you would like, please email me. Obviously, I've offered the discounted financial review, which I think is really worthwhile. It is not time consuming, and the only thing I ask people to do is just allow us the opportunity to have a look at your existing arrangements, and we can do that for you. And then we provide a very simple report for you on a spreadsheet that you can understand and see exactly where you are, and then we make some comments in relation to, I suppose, where we feel that there may be improvements without any obligation, of course, on your behalf. Thank you very much again to all of you. I hope you enjoy the weekend, and we look forward to hopefully speaking to you soon. Thank you very much.